to deal with. All right. Okay, so guys, if you all are hearing me, just give me a thumbs up. All right, beautiful. All right. All right. Okay, so I also need to let you know that if you have any questions, I guess maybe after the lesson, you can present your questions to me. Okay, so let's get started. Okay. Now I know that most of you would not have done accounts before. And of course, I need to start from that stage where I will assume that you do not know anything about accounts. So I'm going to try to make it as easy as possible for you to understand. All right, so we're going to start with our first session. Of course, you know that you are doing PoA, Principles of Accounts. All right, and the first question I would like to ask is, when you think of accounting, what are some of the things that come to your mind? And more or less, you're going to see where I have here on my slide. Some of you would not be familiar with some of the wordings there. You're going to see things like collecting debit, credit. You're going to see classifying, recording, financial. All of these stuff more or less is more or less going to be like chaos in your head. So I am here to bring clarity to you. So do not look at the bulk. Do not look at the bulk of words that you're seeing there that looks like Greek. Don't let it confuse you. The aim is for us to take it one at a time. All right. So today we're going to look at, right, this is our objective for today. We're going to give a definition of bookkeeping and accounting, and we're going to classify accounts, which is more or less the classification of accounts. We are going to identify the users of accounting information, describe traditional and emerging careers in the field of accounting. And hopefully after that, we are going to touch on the accounting systems, which is more or less the basic part of the accounting cycle. So it sounds, as again, I said, it sounds like Greek, but do not let anything there confuse you, because I'm going to walk you through to the 4-week session. And of course, I'm welcome to take any questions after. Okay. Okay, so you are not to write down the Shani, Thomas, you're not to write down anything, because I believe it's going to be on YouTube after, so you would be able to access it there. All right. Good. So let's continue. Let's continue. Okay, Shani, great. Good. So bookkeeping. What is bookkeeping? The definition given is bookkeeping is the first stage in the accounting process. It is defined as a process of recording business transactions accurately in the books of accounts on a daily basis. So when you think of the words process, think about all of the paperwork that is involved in recording information in a book. Think about all documents that you are going to come across. You're going to come across things like sales invoices, purchases invoices, And these are going to be recorded in these respective books. Okay, so bookkeeping is more or less you as the bookkeeper, you are going to be able to look at certain documents and you must be able to identify what is a sales invoice, what is a sales invoice, and you know that sales invoice will go into your sales book. You would also come across a purchases invoice. And of course, the purchases invoice is going to go into your purchases book. You're going to have cash transactions. And of course, you will have to be able to put that cash transaction in your cash book. So really and truly, bookkeeping is more or less paying attention to the books that you are going to be dealing with and recording the respective documents in those books. Okay, now as again I said, it's going to appear to be like Greek, but as time goes by you will understand what I'm talking about. All right, so that is in relation to bookkeeping. All right, what is accounting? Okay, guys, what I'm going to do, I'm just okay, so guys, if you all have any question based on the first part that I just told you about bookkeeping, you can ask your question, and of course I'm going to glance at the question. I'm not very good at multitasking, but I hope to be able to answer each and every one of your questions, okay? So the other definition is, what is accounting? Accounting can be defined as the process by which financial information about a business is classified, recorded, summarized, interpreted, and communicated to owners, managers, and other interested parties. Now, I know it sounds like a lot of clutter taking place there, and you will probably ask yourself, what does Miss mean by classified, recorded, summarized? What does she mean by that? So what I have done, I have extracted some of these words that I have used to define accounting, and I'm going to break it down for you a little more. Okay, so let's look at it. Right. So as you can see my heading here, the first description given for accounting, it's about classifying. So I told you that classifying is Greek to you. You would not understand it. So I'm going to tell you what they mean by accounting is about classifying. So when you classify accounts, it's more or less going to be divided into personal and impersonal accounts. So it's more or less putting it in a category. So you are looking at your accounts and you are putting it into a category. You are putting it into personal accounts and impersonal accounts. So personal accounts, think about persons. So you're looking at, of course, the definition. Let me give it to you here and then I'll tell you. By example, personal accounts are ledger accounts, an account or record used to store bookkeeping entries that record transactions pertaining to people. So when you're taking the note there, make sure and put, underline people. When you think of personal accounts, you think about people, okay, who are referred to as debtors in accounting, or creditors, okay, or capital accounts, okay. All of these are persons. Of course, I did not give you the meaning of a debtor, okay, But debtors are people who owes the business, sorry. Creditors are people who the business owes. Capital is more or less the money that a person of a business who wants to start a business, the capital is the money that he or she puts into his business. It is referred to as capital. All right. It doesn't always, a personal account doesn't always have to be a debtor or creditor, persons only. It can also be banks or companies, or all of those fall under the category of personal accounts. Okay. And then, of course, the other classification is impersonal accounts. So when you think of impersonal, you do not think of persons. You will think of course, I'm going to give you the definition here. Impersonal accounts are accounts which are not held in the name of persons. So you see the word not. It is not held in the name of persons. It can be divided into real and nominal accounts. So what are real accounts? These represent things that, sorry, I am supposed to put in things that we can see, touch, or move. For instance, a building would be considered a real account because you can see it, you can touch it. You may not be able to move it, okay? However, fixtures and fittings, when you think of fixtures and fittings, you think of things that you will have in a business, the computer, the desk, the filing cabinets, all of these things are fixtures in a business. So those are things that you can see, touch, and move. It is not a person. Motor vehicle is also a real account. Stock is more or less the goods that a business will purchase to sell, okay? So all of those are considered real accounts. Nominal accounts are accounts that are related and associated with losses, expenses, income, gains. And of course, the nominal accounts are accounts that you will see in a profit and loss account. You may not know about the profit and loss account now, but as we go along, you would be able to make up a profit and loss account, which is a statement, and you will see all of these examples that I've given you here, you will come across it. All right. So do not bother with, having to absorb any sort of excessive notes right now. It's just to have a basic understanding. All right. So let's move on. So that is classification of accounts. So that's the first definition given for accounting. All right. So a bookkeeper must be able to classify the accounts into personal and impersonal. Let's move on. Another thing that is being said about accounting, it says that accounting is about recording. So what is recording? This is a phase where original source documents are recorded in a systematically and chronological manner in the appropriate books of accounts. So when you think of source documents are things like your invoices, your checks, your receipts. All of those is what we would look at as source documents. And of course, these source documents are going to be entered in these respective books. Now, there are more books here. I did not include Petty Cash book, but it's also one of the books that you're going to be using as well. But these are the basic ones. These are the most common ones. The sales book, the purchases book, the cash book. So you take your information from your source documents and you record it in your sales book. You record, like for instance, you will have an invoice, a sales invoice. That's a source document. You record it in your sales book. Okay, just a minute. Let me just, you can. Guys, I'm going to take all of your questions and I'm going to definitely, just a minute, I'm sorry. No, we do not have to write down anything. You're going to be able to access it via YouTube after. Okay, so yeah, just know that. Good. Right, so let's continue. I'm sorry, I'm just trying to multitask here. Next slide. Okay, so as I told you, your sales book, what are you going to record in your sales book? All sales invoices on credit. Okay. You also have your purchases book. What are you going to record in your purchases book? All purchases made from suppliers. What are you going to record in your cash book? All cash received, all cash paid. So in time, as we go along, you will know what source document goes into these books, okay? I told you the petty cash book, which is what I have not indicated there. The petty cash book is also one of the books where you would record small items that you will purchase for, let's just say if you have an office and the office needs things like tea or toiletries, all right? Any one of these things would be recorded in your cash book, all right? So let's go on. Right. We have, I'm just having a little problem just coming through, you know, just like more or less putting my slide in order here. The other definition given for accounting is, it is the preparation, summarizing, sorry, is the preparation of financial statements at the end of a particular period. So this summarizing is more or less for the accountant to do. Bookkeeping is where you will have the bookkeeper doing the sales book, the cash book, the petty cash book, the purchases book. Once they have prepared all of these books and they have run totals on these books, more or less, you're going to come to the summarizing. And the summarizing, it's being done mainly, that is the aspect of accounting where the accountant take charge of all of these totals, these summarized figures, okay? And she puts it, he or she puts it into an income statement and a balance sheet. And this is what the summarizing is all about. It is about taking a summarized total from all of the books that we spoke about before, and we put it into the income statement and the balance sheet. Okay, so that is just a quick, more or less, way of telling you about the basics. Okay, let's move on. Now, once the accountant has prepared the summarized information into the profit and loss account and the balance sheet, what he or she does is she now or he interprets and communicates this information. Interpret, when you interpret, this is the stage where you more or less help the users, and we're going to come to the users of the accounting information shortly, all right? So at this stage, it is where the users interpret and communicate accounting information from financial statements. So the accountant is the one who will prepare the financial statements. And of course, it has to be interpreted by the users. It has to be communicated to them as to what is happening with the accounting for that particular period. All right. I hope that part is clear to you. All right, so let's move on. Just a minute. Okay, so I use the term here, users of accounting information. Each of you could be users of accounting information. We have some users, okay? So let us first see who. Just a minute. Yes, let us just look at the users of accounting information. So when you think of the users of accounting information, think of stakeholders. That's the term used for users of accounting information. Stakeholders, all right? These are individuals and organizations that have an interest in how a business performs. Okay, so if it is, as I said, each of you could be a user of accounting information. Why? Because you want to know how well a business is doing, then you would be a user of accounting information. So it is possible to divide stakeholders into two categories. We're going to look at internal stakeholders, which are those who work within an organization or who work in a business. And then we have external stakeholders. Those are the ones who work outside of the business or outside of the organization. And I'm going to break that down for you a little more. Just hold 1 second, guys, hold 1 second. Okay, so guys, let me just make it clear to you that I will only open the chat when it's questions and answers. Other than that, I am not going to open the chat. Okay, I am just seeing some distasteful stuff, and I don't think it's appropriate right now for my eyes. So we are going to move on to the users of accounting information. As I said, we have internal stakeholders, which are internal users, another name for stakeholders, users, and we have external stakeholders, okay? You need to be able to differentiate between the two. So let's move on. So I've given you 3 types of internal stakeholders. So we have the owner. Why is the owner an internal stakeholder? Because the owner is the one that owns the business. It's his business. So the owner is internal. He works in the business, not necessarily working in the business, but he owns the business. All right. And let us see what the internal stakeholder or shareholder. Now, again, I have used the word shareholder there because an owner doesn't always have to be one person. If you are dealing with a company, the term used for owners would be shareholders, and they are also owners. So you can own a business individually, as well as you're going to have, you can have a company where you have shareholders, many people who would have invested in your business. And of course, they are all owners, okay? So let's look at the internal owner or shareholder. So what it is, would they be interested in? What it is, do they do? They assess the profitability and financial status of the business so that they can decide their future course of action. So the owner, of course, would want to know how much money is the business making? Are we losing money? Are we making money? So they need to be able to see financial statements to be able to answer that question. Are they losing money? Are they making money? It's only the financial statement that would have been prepared by the accountant. Then is when that owner is going to have an idea as to whether the business is doing well or not. Then we have another stakeholder, which would also fall under the category of internal, which is the manager. They are responsible for decision making and to evaluate the performance of the organization, okay, or the performance of the business. Now, the manager has a very important function, because if it is the owner employs a manager to oversee the running of the business, the manager has to ensure that whatever decision that is being made in the business, it's going to be good for the business. And then we have another internal stakeholder, which is the employee or employees. They are dependent on the success of the business for their wages or salary, or as well for continued employment and retirement benefits. Now, why would an employee be a stakeholder? Now, definitely, if you are working in a business, you wouldn't want to work there on a short-term basis. You may want to work on a long-term basis. So if you are working in a business on a long-term basis, you need to be able to know that the business is doing very well so that they can pay you, because you do not want to be moving from job to job to job constantly. So the employee is a stakeholder, and they need to be able to see the success of the business so that they can be guaranteed their wages. Now, wages or salary, they are both monies, remuneration that employees earn from a business. So they need to be able to know that their wages or their salary are paid on a timely basis. There is no situation, there wouldn't be a very understandable situation where, let's just say, an employee works for, let's just say, a couple of weeks or a fortnight. And then at the end of the fortnight, the employee is being told by the employer, oh, we do not have money to pay you at this point in time because production was very slow. The employee would not want to hear that. The employee would want to switch, move from that job. So really and truly, the employee would like to know that the business is doing very well so that they can get their wages and salary on time. They can continue their employment. And of course, if we have very old people, when I say very old, I don't mean in terms of, old in the sense where they are feeble, but you might have senior employees who would have given, let's just say 30 years to a business, and they would need to know after they have worked for like 30 years, they cannot just go home barehanded. They need to know when they go home to relax, they need to know that they have a lump sum of money in their hands. so that that can take them through to the balance of their life. Okay? So it's important for employees to know about the success of a business for these reasons. Okay? We're going to move on. Let's look at some external stakeholders. We have the investors, and I will just read each and briefly give you a little, clarity. So investors, they will be concerned about the risk of investing and the potential returns. So investors are more or less individuals. You can be an investor in a company. Let's just say you think that a company is doing very well. You could be an investor. And a company can also invest in another company if that business is doing very well. So why? Why do you invest? You don't invest because you have the money to invest. You invest to make money. Okay? So the investor would love to see your financial statements to see how well the business is doing. Then we have the other external stakeholder is the supplier. They need to have an idea about the credit worthiness of the business so that they do not experience difficulties when payments are due. A lot of times what happens is when people, let's just say a supplier, he provides you with goods and he gives you a time period to pay, let's just say 30 days. And it so happens that because the business isn't doing well, sometimes the debt goes into 60 days and the company or the business cannot pay. So suppliers would need to look at your financial statement to see how well the business is doing financially in order to know whether they should provide you with goods or services. If they are not seeing very good feedback from your finances, they are not going to supply you with goods. Then we have the customers. They depend on the business being successful so that they can rely on being able to buy goods when they need them. Now, I'm sure that we have quite a lot of young people here who would love their brand name sneakers, all right, or phones. They might like their Apple phones and stuff like that. So really and truly, if you are running a business that sells brand name sneakers, you would like to know that that business is doing very well so that they can restock their goods ever so often when it's no longer in stock. If your financial statement shows that you are not making money, obviously you will not be able to buy the goods to restock your business. And that does not look very good. So there is where the customer would need to know about the financial situation or the financial status of a business. Then the bank, well, of course, the bank, if it is you have a business and you want to get a loan from the bank, they are going to definitely look at your financial statement. If they can see that you are making money in your business, they would be more than happy to give you a loan because they know that they are going to get interest from the loan they would have given you. So the banks are very, very particular about how well your business is doing. All right. And then we have the labor unions. They would need to evaluate the ability of a business to increase employees' wages or salaries. And I'm going to break down this to you because there are many reasons for the labor unions taking an interest in the financial statement of a business. So they would need to evaluate the ability of the business to increase employees' wages or salaries. So we know that labor unions are interested in making sure that their members are in fact being paid, all right, let's just say a good enough salary for them to survive or increase their standard of living. All right.